Hello, and thank you for listening to this webinar. My name is Bill Bonk, and I am the Group Director of Global Benefits for TTI. TTI will be adding a new medical plan option for 2018 called Plan 3, in addition to the existing Plan 1 and Plan 2. Plan 3 is a high-deductible health plan that allows you to also enroll for a tax-free savings account known as a Health Savings Account, or HSA for short. Paired together, Plan 3 and an HSA provide you with a tax-free way to save for your current and future healthcare expenses that is not available with traditional medical plans like Plan 1 or Plan 2. All three medical options, Plan 1, Plan 2, and the new Plan 3, cover the same broad lists of services. There's no difference between any of the three medical options when it comes to covered and excluded services. You should not base your decision on whether or not to enroll in Plan 3 on whether or not a particular service is or is not available, since they're all the same. The difference between the two traditional options, Plan 1 and Plan 2, and the new Plan 3 is when the plan starts to pay for services. Under Plan 1 and Plan 2, when you use an in-network provider, many services are paid at 100%, 80%, or with various co-payments without having to first meet an annual deductible. Under the new Plan 3, the opposite happens. Except for a limited number and lists of preventive services, which are still paid at 100% without a deductible, all other services under Plan 3, including prescription drugs, will not be paid until you have satisfied your annual deductible. The design of Plan 3, specifically the amount of the annual deductible, is controlled by the IRS. In exchange for allowing someone to have a health savings account, the IRS has set various rules and guidelines that must be followed. These include the minimum levels for annual deductibles. Each year, the IRS adjusts these minimum levels, and TTI will need to adjust our levels to comply for future years. For 2018, TTI has set the Plan 3 deductibles at the lowest levels allowed under law. You cannot enroll for the health savings account if you elected Plan 1 or Plan 2, or if you waive medical plan coverage. Another important aspect of Plan 3 is the deductible. For employee-only coverage, the deductible is $1,350 in network. For any other coverage level, employee plus spouse, employee plus children, or full family, the deductible is $2,700. Now, this may sound a little confusing, but if you have anything other than employee-only coverage, each person or combination of people must reach the $2,700 limit before benefits are paid. For example, if you're covering you and your spouse, your individual deductible is $2,700. The following examples outline what you would be expected to pay for a large medical plan claim and a non-generic prescription drug. As you see, your out-of-pocket costs are higher under Plan 3. While it looks like Plan 3 costs you more, you should consider the advantages available to you under the health savings account before you make your final decision. A little later on, we'll show you some examples to help guide you through this decision process. This chart shows you the way that Plan 3 differs from Plan 1 and 2 in deductibles and out-of-pocket expenses. You'll notice that both the deductibles and out-of-pocket limits are higher at all levels under Plan 3. It's worth noting here that prescription drugs for Plan 3 are subject to the same annual deductible as all other medical expenses. Plan 1 and 2 have separate prescription copays that are not available under Plan 3. Under Plan 3, with the exception of preventive medications, you will pay 100% of the negotiated discount costs of all prescription drug charges until you reach your deductible. HSAs provide three types of tax savings. The funds are deducted from your paycheck before tax, very similar to how a 401k works. Once your funds are in your account, they can earn interest or be invested tax-free. And when the funds are used for qualified health, prescription, dental, and vision care expenses, the funds also come out tax-free. The HSA is exclusive to Plan 3. When you elect to participate in the HSA, a real bank account is opened in your name with Health Equity, the health account administrator we have selected to administer the TTI HSA accounts. Each pay period, the amount deducted from your paycheck for the HSA is deposited into this bank account. The account is linked to a debit card in your name. Funds in your account earn interest, and once you build up a balance of $1,000, you can move funds into various Vanguard mutual funds. Your HSA and the money in it belongs to you, not the company. Also, should you ever leave the company, you can take your HSA account with you. You never lose or forfeit money deposited into your HSA. An HSA has some enrollment, payroll, and operating features that are similar to a flexible spending account, but that are different in key ways. For the first three items, annual elections required, before tax deductions from your paycheck, and the use of a debit card, they're all the same. All three of those functions are available under both the HSA and FSA programs. The use it or lose it feature that is common to the flexible spending account is not applicable to an HSA. You never lose that money. It rolls over from year to year. You can take it with you when you leave the company. You actually get a bank account issued in your name under an HSA. That is not the case under an FSA. Money can be used for future years' expenses under an HSA, not so under an FSA. Under an FSA, you can use funds that you have, your goal amount that you've elected, before you deposit money into the FSA. Under the HSA, that's not the case. You only can use money that you have actually deposited into your bank account. It's the same way as a checking account. Your account does not earn interest under an FSA, and yet it does under the HSA. These are just some key differences that you should pay attention to. In 2018, you can deposit as much as $3,450 to your HSA if you enroll for employee-only coverage. And up to $6,900 if you enroll for two-party or family coverage in Plan 3. If you're 55 years or older, you can contribute an additional $1,000 per year. Let's look at some pros and cons to Plan 3. Generally, employee contributions for Plan 3 are lower than Plan 1 and 2. You get the triple tax benefits of money going in tax-free, accruing tax-free, and withdrawing tax-free. You can budget how much to contribute. Unspent dollars are never forfeited, and it's a good way to save for the future and for retirement. You can use your HSA to pay for current medical expenses that Plan 3 may not cover. You can start and stop your payroll contributions at any time without a life event. Post-tax contributions could be made into the HSA anytime outside of payroll, as long as you are enrolled in an HSA plan. And funds within the HSA can be used for any tax dependent, even if they are not covered on your TTI insurance. On the con side, you may pay more out of pocket for medical expenses. You have to meet the family deductible before the plan pays any benefits if you have anything other than single coverage. All prescription drugs apply to the deductible. And as illness is unpredictable, it's tough to accurately budget for your yearly medical expenses. Because of higher deductibles, if you don't budget enough in a given year, you may have significant unexpected out-of-pocket costs, especially if you face a large medical expense. And since an HSA is a savings opportunity, some people do forego getting the care they need to avoid spending money from the account. Certainly not a good practice under any circumstances. Is Plan 3 right for you? The decision is different for each individual. If you're generally healthy and/or have a reasonable idea of your annual healthcare expenses, then you could save money from the lower premiums and tax advantages that an HSA offers. However, if you're more prone to illness or unexpected medical conditions or prefer certainty in medical costs, the possible risks of unexpected out-of-pocket medical expenses, you may want to stick with either Plan 1 or Plan 2. You will pay more in monthly premiums. Plan 1 and 2 will start paying for your medical expenses sooner than under Plan 3. We've created a comprehensive modeling tool to help in your decision-making process. We've created 3 different examples of scenarios that we think many of our employees may encounter. Contact your HR department if you would like a copy of this modeling tool for your own use. In this first example, we're going to look at an employee who makes $62,000 a year and signs up for employee-only coverage. There are certain pieces of information that you're going to have to obtain before you can use this model effectively. In step 1, you need to put in your pay cycles, and there are only the number 52, 26, or 24 go in this box. So you enter your number of pays. Then from the contribution schedules in your open enrollment materials, look up your medical cost per pay period. In this example, this person works for One World Technologies, and on the non-smoking rates, the medical plan 1 costs $30 a pay period. Plan 2 costs $19.38, and Plan 3 costs $17.08. Also in this example, this person wanted to contribute $1,000 to either the HSA or the FSA. And so you put the dollar value of what you want to contribute in there. And step 2 is where you need to have some of your tax information handy. So go to your 2016 federal return and enter in the 2016 federal adjusted gross income. And then enter your tax liability. And this calculation takes you also, if you have a state tax, you enter that number in there. And this gives you your effective income tax rate. Now, it's different than your marginal tax rate. So we decided to take the conservative approach. So we were really painting any additional tax relief that you get through deductions that you file for are an added benefit to this example. So step 3 is where you enter your medical expenses. It's important that you do not enter any preventive office visit information in here. The reason is that's covered at 100% under all 3 plans, and there's really no differentiators there. So in this particular case, this individual is going to have 1 doctor office visit that's not preventive, 1 lab or x-ray, and then 1 generic retail filled prescription, 1 brand prescription, And you'll see the average costs of the items and the total annual cost calculated there. And on the next page, this continues with, mail order, generic. This individual doesn't seem to have any. And then there's a place in here where you can put in any other medical expenses that aren't covered under the medical plans. For example, eyeglasses or orthodontia in excess of the dental coverage. Anything that an individual thinks that they need to have or would want to add in to count towards medical expenses, they can enter that into here. Step 4 is where the calculations start to accrue. This is what you'll pay for office visits. So it takes the medical information above, applies the plan design calculations for Plan 1 and Plan 2, and produces the results here. So at the bottom, you'll see the total annual cost for deductibles and copays in Plans 1 and 2 of $406. Plan 3 is blacked out in those areas because everything goes towards the deductible. So in this case, all of the costs, as you'll see the annual medical costs outlined above in Step 3, roll down to plan to the employee only or the family coverage of $495 in box 1 and 2. Depending on your coverage level then, in Step 5, you take your employee only or your family cost and you put this in the gray box. And what this does is then summarizes all of your annual medical insurance premiums, your medical expenses, your annual cash outlay for healthcare expenses and payroll deductions. It factors in the tax savings based on the information that you entered, and it calculates your total net effective cost for healthcare and insurance. So you can see under Plan 1, this individual would actually spend in both expenses and in tax savings or lack of tax savings, $748. Under Plan 2 would be $540, and under Plan 3 is $584. Now on the surface, this looks like Plan 2 is a better fit for this individual. However, what's not calculated here is that, remember, they put $1,000 into the flexible spending account. Well, based on this calculation, they're only going to spend $406 of that $1,000. So that means they will lose $600 because of the use it or lose it feature. So unless they accommodate for that in some other manner, they will lose that money. That does not happen in Plan 3. That money rolls over from year to year. It stays in that account and you can use it. It never expires and you never lose it. So you would have to potentially add another $600 to this $540, which clearly makes Plan 3 the better option. In example 2, we took an employee and spouse making $75,000. This was a floor care example, so they're paid they have 24 pay periods. We use the floor care contributions of Plan 1, Plan 2, and Plan 3. An annual HSA contribution of $4,000 compared to a flexible spending account contribution of $2,550, which is the maximum that you can put in. Scrolling down to Step 2, we see the $75,000 income and the taxes and the marginal tax rate, the effective income tax rate of 26%. This family, again, doesn't have major medical expenses. You're going to have one minor surgery at some point in the year. A retail and a mail or a generic prescription drugs. There's a mail order component to this person, this family, and they say they're not going to have any additional medical expenses. Again, low utilizers of medical care. Step 4 is a calculation of the Office visits and the application of the plan design. Again, the entire $1,870 of annual medical costs under Plan 3 is applied to the $2,700 deductible. That's why it's calculated down here, and this portion is black. And then under the final calculation, you put the $1,870 in the gray box, and this shows where the total net effective cost for health insurance is $2,400 for Plan 1, $1,800 for Plan 2, and $1,900 for Plan 3. But again, they put in $2,500 into the flexible spending account. If they don't use it, if all they use is $1,870, I'm sorry, if all they use is $1,257, they will lose the balance, which again makes Plan 3 a better option. In the third example, we took full family making $100,000 a year, being paid 26 pay periods. Again, the contribution schedules were applied here. This family wants to put the entire $6,900 into the health savings account and or utilize the full flex spending account at $2,550. Again, the calculation of the taxes. They've got kids, so there's 4 office visits and 6 lab or x-rays. There's some minor surgeries, maybe some broken bones. There's a number of retail prescriptions that are filled per year, 1 brand, a mail order, and they think that there's going to be about $900 in additional expenses of medical coverage. So total under Plan 3 would be $4,720. You can see when we apply the deductible, they've reached their $2,700 deductible, and for total costs of $3,104. You put the $3,104 in the gray box, and you'll see here where there is a substantial advantage of Plan 3 of $2,460 versus $3,200 and $3,800 under Plan 1. These examples really demonstrate the power of the tax savings and the fact that these are savings accounts that you're building up, very similar to a 401k again, that you can use for qualified medical expenses as you go through life. So that pretty much covers Plan 3. It's an exciting new opportunity. It may or may not be right for you. Please review all the information in the open enrollment material, much of which was repeated here, but we'll be happy to email you a copy of this presentation and the medical plan comparison tool. Simply outreach to your HR representative, and we'll send it along. Use the tool, play with it. It'll help you guide in making your decision on whether that plan is right for you. And then log into the TTI Benefits Center at ADP and make your elections. I want to thank you for taking the time to listen to this presentation. It's been my pleasure to provide it to you. And have a great day, and we'll talk to you soon.